Okay, good evening, guys. Before we start, let's do a customer instant poll. Check everyone can hear the volumes correctly. Put that on your screens now. Let me know the sound is perfect, too loud or too low. Okay, Jamie's just saying it's perfect, so is Leonardo. Cheers, guys. We're a fairly small group today. I've been away for a couple of weeks, and this is a Monday, so not on the usual time slot. But we'll go through it as always, guys. We're going to talk about FX pairing tonight, so all about the correlation between the different currency pairs. Before I start, as always, risk warning. Spread betting, CFD trading carry a high risk your capital, resulting in losses that exceed your initial deposit. It may not be suitable for everyone, so please ensure you fully understand the risks involved. Information provided herein under no circumstances are considered an offer or solicitation to invest. Nothing herein should be construed investment advice. Information is believed to be accurate at the time and date it is produced. Again, education only. Content of the webinar is personal opinion of the moderator, not Untitled.com. The content is not constitute financial investment or tax advice. Untitled.com does not accept any liability for the content or comments made during this session. So, the FX markets. So one of, if not the most commonly traded markets in the world. We have around about 4 trillion traded every single day on the currency markets. So there's two main types of currencies that we want to look at, and that'll be the floating and the pegged. Which one is most traded? Well, I mean, generally it's going to be the floated. But when you think about the whole rationale and the whole reason why currencies are pegged, means that in the very nature they have to be traded more. I'll go through this in a little bit more detail in the rest of the presentation, but a floating currency is one that's exchanged on a free open market, but a pegged system is like China's currency. You know, they don't have interest rates controlling inflation and their main kind of economic cycles. What they do is they buy other currencies against their own in basically being able to peg it against the strength of a particular currency, which is generally the dollar. So most common currency pairings we're going to trade will be things like cable, sterling, and then this is like the pound against the dollar, the euro against the pound, dollar versus the Japanese yen. Dollar Swiss is quite a popular one. The Swiss seem to be a safe haven. So in times of uneasy market conditions, the Swiss is heavily traded, very much like gold is traded in times when the market seems to be very uneasy. Euro against the dollar is probably the most traded currency, I would say, currently. Obviously, the two main world currencies, and although they're fairly equal, I guess, in terms of the market credibility, the dollar for me is still much more value on the longer term. You have to think as well, when you're talking about how much dollars are traded within the world, you have to think that everything that's priced from oil to gold and everything that's traded against the dollar is priced in dollars. So for me, I don't really see how people can argue that it's not the strongest and most important currency in the world. And there will be arguments against it, as there always are. But for me, I'm always going to be buying dollars against pretty much the majority of other currencies. But again, that's just my personal opinion. Another good one to look at is the euro dollar versus the CAD, the Canadian dollar. It's currency correlations. So currencies are priced in pairs, so you can't trade a single, like you can't just trade the dollar outright. Really, you have to trade in a pair against something else. So the first one will be the base currency. So if you're trading the euro dollar, you're trading the euro in the price of dollars. And again, people tend to think that currency trading can be quite complicated, but really it's just thinking about the strength. I mean, just looking at the basics of what countries are out going to perform each other. So you can look at that in terms of GDP, the gross domestic product. You can just do it in terms of economic activity. Again, we've heard some worrying kind of things out of Japan recently, and they said it's just a blip. So if you're trading the dollar versus the Japanese yen, so that's the dollar being the base currency against the Japanese yen. So if you think the US is going to come out of recession or out of this particular economic cycle in a stronger position, and it's going to go back to having more manufacturing, back to having better economic figures, quantitative easing is going to remain for the short term, then you start to buy the dollar against the Japanese yen, who seem to be failing, whose economy seems to be stuttering. So that's as simple how you do it. It's just basically pitching one economy against the other. So some currency pairs will move in the same direction with the same kind of sentiment as others. Like any other market, they're going to move in different directions. There will be particular currency correlations and coefficients, as we call them, but they won't always move in sync. You can get some quite nice tables that tell you the strength of currency correlations with each other, and they'll be fairly obvious, but there are ones you might not think are so obvious. You can trade these in two ways. You can look for that very, very strong correlation and look for divergences between markets, or you can just trade one against the other. Again, just like with trading any other products, be it indices, be it commodities, you have to try and make trading the currencies as simple as you can. So again, it's going back to them basic rules that I said. That, just try and pick out which country you see performing better, or excuse me, over the short to medium term, rather than trying to get too microeconomics with these things. Trying to get into too much of the individual policies and the nitty gritties. Just look at these things on a broader spectrum and try and see when the big swings in the currencies and markets will kind of pitch in. So once you've identified both the negative and positive correlations, again, you can start to build your strategy and your charting setups around this. So if you're going to trade mainly US dollar versus currencies, then maybe you have the S&P up. So again, the S&P will be a strength indicator of how strong the US economy is. So that will have an effect on the dollar. So maybe then you trade the dollar versus the Swiss, the dollar versus the yen, the dollar versus the euro, and you can see how maybe, again, put the gold up against it. So when people are going into gold, what effect does that have on the dollar versus the other currencies? When the S&P is going up or down, what effect does that have on the dollar against other currencies? So remember, not always necessarily the direct correlations you think. There will be indirect correlations, and obviously, as I said before, there'll be currency coefficients in how currency pairings themselves, how strong they correlate with each other. So maybe the dollar Swiss and the dollar euro, have a good correlation together. Okay, and maybe then the dollar Swiss and the dollar CAD have an inverse correlation to against each other. And these are things you have to look at, because it's all about finding that particular edge, no matter how small it is, and understanding how you can build a trading decision and a trading call based upon that. One thing I like about the currency markets is because they are so big, and even when you have the big players like Deutsche Bank and UBS they can't really manipulate the currency too much. Like you can see the quick blips in perhaps commodities or quick blips in the stocks. That doesn't really happen so much in currencies. It's more of a gradual move. So for me, they're the best markets to start trading with when you're learning to trade. And if you want to hold multiple positions, for me, it's generally a lot easier doing that based upon currency coefficients rather than just having a different number of stocks or a different number of indices against each other. So the currencies are better for that, in my opinion. Let's go to coefficients. Now, the coefficients is a statistical measure of how strong a relationship different pairings have. As I said, you can search the internet for these things. I think MetaTrader and MT4I have their own currency coefficients, which are just calculated on a grid, and you can see the change per hour, per day, per week, per month. No more complicated than that. So the currency coefficient ranges between -1 and +1. So a correlation of +1 implies that two current pairings should move the same way 100% of the time. So like anything in trading, anything in life, you're never going to see a +1 because nothing ever moves 100% in the same direction. And even if it did, it wouldn't move at the same time. Okay, so a +1 is a very, very strong correlation. Conversely, -1 implies that the two currency pairs should move in the opposite direction 100% of the time. Okay, so again, you never see that. And then 0 is generally there's no relationship at all. And really, it's just building up an idea and almost a bundle of currencies, maybe 3 or 4 that have a very, very strong correlation. So, you put that with your positive. So anything plus 0.8, 0.9 is going to be a strong indication these currencies move in the same direction. So maybe only have 4 or 5 currencies, but if one currency is spiking in a particular direction, then eventually that's going to have a pull-through effect to the other 3 or 4 currencies. So again, it could be another way of triggering your entry point. If one very strong correlated coefficient starts to move in one direction, then there might be an opportunity to jump on one of the other currencies that hasn't moved yet. And again, that's just the same if you're trading like the arbs between WTI and Brent oil, for instance. If one moves strongly in one direction, the other will generally follow. So currency coefficient is something really good and something really useful to look at in that way. And again, you just do the same with the negative correlations, things that move in the opposite direction. And again, mix them up. Maybe if something is the opposite polar ends and one aggressively gets sold off, then again, look for the one that's going to be bought up, the one that's always moves in the opposite direction. So again, if you see that the currencies are fairly flat across the board, however, just for argument's sake, the dollar Swiss has moved 150 ticks in a straight line upwards, then maybe the dollar CAD is going to move down because the dollar and the Canadian dollar, again, the same region of the world, the same kind of economic type. So maybe that's going to move, negatively. One other conversely correlating market is spiked up. So again, it's one thing to investigate, a different way to set up your charts, and a different way to kind of view what is a very fluid, very liquid market. Again, you can use your other oscillators, your other charting techniques, your candlesticks, your RSI, your MACD, etc. With all these type of things are tied in. But again, it's just a good thing to look at. It's good practice. If you have a basket of 10 currencies, 10 currency pairs, and you see that only one is moving out of 10, then what does that tell you? What could happen to the markets? Are they strongly correlated? Are they inversely correlated? Could something, if something moves very, very strongly in one direction, that will always have a ripple through to the market. It might only be small, but it might be a 15, 20 tick move that you can put on with some good size, because it's a high probability trade. And again, without knowing about these things, you don't plan for them. And as we know from all the things that I've told you over the years, if we don't plan, we're going to be caught off guard. Okay, and we're not going to make the most of that opportunity. We'll get in late or miss it completely. So again, with all the things I teach, being rigid, understand when economic data is out, when key speakers are speaking, all these different things, the currency coefficients and how they react against each other is another one you should, really, it should be a no-brainer on your trading plan. It's like, okay, well, what's the major currencies doing? What's the euro doing? So what's the euro doing against the dollar? What's the euro against the Swiss doing? Again, have 5 or 6, maybe 10 different currencies that you can just have on your charts, or again, just look down your market watch, which you can do in InterTrader, and just understand, if one currency is moving out of sync, and if it is, will it have an effect on any of the levels you're looking at in other traded currency pairs? Okay. So again, it's just about being prepared and understanding. So the coefficients that generally move positively and negatively are these. So again, these are the ones you'd be looking to trade against each other. So the euro dollar and the pound against the dollar, they'll generally move in the same direction, whereas inversely, the euro dollar versus the dollar Swiss are inverse. Okay, and you can see why. I mean, Europe is a big trading partner with the dollar. Okay, with the US, so that is a market that will move. Okay, in the same kind of direction. So if you're trading that and you're trading against the pound against the dollar, well, the pound is in the EU. The EU is Europe. Europe is a big trading partner. So you'd understand why them particular currency pairs are moving in the same direction. But if you're trading the euro against the dollar and then trading that against the dollar Swiss, well, again, as I said, the Swiss is a safe haven. Okay, so that will be generally doing the opposite of what the strongest currency is doing, which is the dollar. Okay, so the safe haven should be strengthening against other currency pairs when there's a lot of mistrust, there's a lot of undecisive economic activity happening. So again, if there's any kind of terrorist attack, you see the Swiss strengthen against pretty much every single currency because the Swiss is, again, seen to be neutral, a safe haven in the world. And that's how it works. Okay, so there's other things, again, the euro dollar and the New Zealand dollar move in the same kind of direction. Again, these are just general outlines of things that I've seen over the years. Again, you can get a real-time, up-to-date view on positive and negative coefficients just by Googling it. This stuff is readily available. It's no secret. And again, you can see an example of the currency coefficients work. This is just an example of the euro dollar and the dollar against the pound, just moving as again we see the peaks and troughs. And it just isn't hard, is it? What you're trying to do is pick out areas of interest. So if you see the market is ranging in this particular part here, again we see that afterwards the market spikes. So what you're looking for is to find out where a particular market is likely to break. So this market here, okay, is ranging. But the break here is much, much slower. We see consolidation and then the green candles. Where in this particular market here, at the same point, we see a big spike. So that spike is already happening. Then again, you want to start longing this market, knowing that it could break higher. It takes longer, but you've got your indication by this one big green candle here. So again, it's just another example of being able to take a chart and understand that we can see breaks happening. And when they do, the other market's going to move in the same direction. So this move here, links in with this move here. When we reach the top, it's probably a lot easier to trade it off this one because see, double top made, the market then moves down. Whereas this market, struggles to make these highs, but it does break down. The market overextends and there's a lot more selling action. So again, it's how you trade into these things. You can buy it from the long side, sell it from the short side. It doesn't really matter as long as you take your cue from somewhere and know that correlated markets will move in the same direction. Then when they break down, okay, they will do it in the same way. So again, the overextension here very small, but a lot more reactive here in this market. So it's not an exact science. It's not an easy way to make money, but it's something to keep an eye on. If you see one market breaking out in big green candles, you can safely say the other market is gradually going to have to be pulled up. So this candle here can give you all the information you want to know to start buying this other correlated market. So the example of a negative correlation, well, it's pretty much exactly the same, but whereas this market takes a lot longer to move down, this is a lot greater downward movement. So again, it's picking the tops of this market here, doesn't really look back. Again, finding a key point in this other market that is a negative correlation and then the market moving down. As I said, if you want to trade the currency coefficients, then you can get tables that look like this, and it'll just tell you that there's the euro dollar here, and we go down in a diagonal way. So if you want to find something with a very strong correlation, then it's here. As I said, anything towards 1 is very, very strong. So the pound against the Japanese yen and the dollar versus Japanese yen have a 0.81 positive correlation, very, very strong. Then if you move again through the chart, you want to see a negative correlation. Well, we have here minus 0.81. So the New Zealand the Japanese yen versus the US dollar versus the CAD. Well, that's not an obvious one to say, but again, you've got a minus 0.81 very, very high, but it's a negative inverse correlation. So you can go through these charts and pick out the ones that might be of interest. I mean, look at this one, the euro dollar versus the dollar Swiss. This particular chart this time, a minus 0.96 correlation. So again, if one of these starts moving in a positive or negative direction, so the dollar Swiss, for instance, then you will do the opposite in the euro dollar. Again, very strong negative correlation. So doesn't hurt to have one of these charts up. It doesn't hurt to do a bit of research. And if you see one of these triggers go off, it's another opportunity again to make money. So trading the correlation and the coefficient. Well, the simple way to do this is by making sure you have a portfolio that doesn't take trades that cancel each other out. So there's no point in taking, for example, using the correlation coefficient of pairings, where the pound versus the dollar and the euro dollar have a coefficient of 0.8, so they move together. So there's no point buying both of these, is there? Because you're just essentially buying the strength in the same kind of moving directional market. So you have to look at things that move against each other or things that move together and one that hasn't moved. There's no point in just buying the same coefficients that move together because you might as well just trade the one product and minimize the risk. So look at the pound against the dollar and the dollar against the Swiss, which have a negative coefficient, then immediately not to hold the same position, i.e. do not buy both because they cancel each other out. So again, that's something to know. There's no point trading and buying the pound against the dollar and the dollar against the Swiss because they're negative. So if you're buying both of them, you're always going to be behind in your trade because they're not going to move in the same direction, the majority of time. So again, it's something to look out for. And again, if you trade a lot of commodities and you trade a lot of currencies, there's no point trading a lot of commodities and then, again, buying the dollar because these things are priced in dollars. So there's no point overexposing yourself, buying commodities that are priced in dollars and then selling the dollar or buying the dollar particularly because you're not going to be able to take advantage of the full extent moves of your commodities. But then also, you shouldn't really be trading too much in dollars because you're overexposing yourself to the underlying dollar risk. So it's just about understanding these coefficients and making sure that you do more of the right thing, more and less of the wrong thing. Okay. So leveraging positions for profit. Well, leveraging, again, is something else we should always look at. So using the correlation between markets means it's possible to double or treble up on your underlying capital and the margin you use if you look at currency pairs with at least a 0.7 correlation. So the example is, the euro dollar and GBP is one such way of using leverage. Okay, so what you want to do, we know these move in the same direction. You don't want to buy them. What you want to do is you want to buy one currency pair and sell the other currency pair. Okay, so you buy the euro against the dollar and sell the pound against the dollar. But you're looking for that divergence. You're looking for that short-term period where they don't move in syncment. So if one currency has moved aggressive against the other, then you sell the one that's aggressively moved up and you buy the other one expecting them to meet parity. So you're selling the one that's had the overextension and you're buying the one that will fit the value. But these have to be currency pairs that are strongly related. So if you see that one currency has moved and the other one hasn't, you buy the one that hasn't moved and you sell the one that has. And then when you do this, you're using much more of your leverage, okay, because you will be able to get more size and more leveraged trading off against each other because you're buying something and selling something. Okay, so that makes sense. So we've gone over how to leverage positions and how to hedge before, only briefly. But if you use this and you use it in the right way, things with a strong positive correlation. If you buy one currency pair and sell the other one, you're actually in real terms using much more margin than you'd be able to trading one outright product. Okay. So hedging Forex for profit. And again, hedging is something I don't like to touch on too much because hedging, although people say it's fairly standard, fairly easy, unless you're trading serious size. When I say serious size, you're trading more than £100,000 a time. You don't need to worry about hedging. You've got enough to worry about. You're trading off the spread. You're trading off a spread betting platform. You're trading with limited size, limited connectivity, limited price availability. So you don't have to worry about hedging unless you've built up a very, very long-term, heavy position in gold, for instance, that's heavily on side. And it have to be heavily. I'm talking tens of thousands of pounds on side for you to worry about hedging the dollar, for instance. Again, because gold is priced in dollars. If you're worried about the weakness of the dollar and you want to hedge in that currency risk, then you can buy other currencies against it. But for me, again, I would only do hedging if you're talking about very, very large positions. So the advantages are, if you want to do hedging, of course, is that it limits the initial exposure. So again, if you're buying an underlying product, maybe you want to hedge off the base currency it's traded in. That protects you against sudden price movements. And again, it allows for less need to monitor to monitor the risk because you're hedged off. So nothing potentially that bad should be able to happen. And also, it allows you to greater diversification of your portfolio. Again, if you're hedging things off, then you don't have to worry too much about what happens, in the currency markets as well as the Forex markets. So the disadvantage is the more you trade, the more you pay. Okay, so if you're buying huge positions in gold and hedging in dollars, you have to take, an equally represented share of dollar risk. And again, that's going to cost you to put that trade on. Correlations can be changed, leaving traders exposed. And it is more complex than it sounds. You have to understand the underlying risk. You have to understand what particular, if you want to cover your entire position, part of your position, how much the base currency is likely or potentially could move. And really, the markets are fairly quiet and fairly steadily directional or nicely trending. There's got to be little benefit really to hedging. Okay, if the world markets are fairly quiet. Obviously, as they are now, very, very volatile. Again, if you're taking big positions, it can be worthwhile hedging. But for me, I would rather hedge, as I said, with currency pairs, be them correlated, be them very, very inversely correlated, or really hedge things, like gold versus the dollar or WTI versus Brent. That's a better way of kind of hedging things. Right now, I would unless you're a very experienced trader with very, very deep pockets, I wouldn't worry too much about hedging. But again, it's part of currency trading. You have to understand that, people hedge in the commodity markets. People that use a lot of oil, Virgin will hedge against oil prices. You have big companies like Apple, that sell a lot of, things in euros, a lot of things in pounds, will obviously hedge, against the dollar because they're a US company. So that's the things you have to think about in the currency markets and why they're so liquid. Everybody's looking to minimize the risk. So, a lot of companies and a lot of, big organizations will go into the currency markets to hedge. And that's all they're doing, trying to limit the risk against their native base currency. So take an example. You know, if you want to sell $1 million worth of euros, and then the outright sell, what you do is sell $1 million euro dollar at a proportionate rate of maybe dollar Swiss, because as we know, they're inversely correlated. So the euro dollar rises against you 10 ticks and you're offside. We have a hedge in place. Okay, so the pairings move inversely. So position 1 rallies 10 ticks, but position 2 moves in the opposite direction 2 ticks to counter it. Then again, you know, position 1, you're selling the euro versus the dollar, 10 ticks offside, so that's $1,000 loss, but you're selling the euro dollar to buy the euro dollar Swiss. Okay, so one's offside, $1,000. Your dollar Swiss is 10 ticks onside because they're inversely correlated, 900. So your actual trading with a hedge is you're only offside $100, whereas without that hedge, you're $1,000 offside. So again, it depends on the size. Okay, majority of people wouldn't want to take a $1,000 offside position, but if you're only 10 ticks, you're taking a very large initial position, that $1 million. Okay, but $1 million, if you're $1,000 offside, not really that big of worry or bigger concern. But you can see how it starts to, when we talk about $4 trillion traded every day on the Forex market. So if you're taking, you know, tens and, you know, maybe even hundreds of millions of positions, you know, you don't want to take that initial spike of volatility when you put the position on. So you can take a hedge against it just to minimize that risk. Now, excuse me, it'll cost you more money in the short term, but it'll waver out any of that short-term volatility. So if you're taking, you know, a $10 million position and you want to take, you know, maybe you might not take an equal 10 million position in the euro Swiss, for instance. You might take half of that because, you know, you're just riding out that initial volatility because you know that, you know, the inverse correlation should mean even if your trade goes offside, the likelihood it is that your other hedging position should go at least some way onside. So you're taking obviously more overall risk, but really, you know, in the real terms, you're taking less risk because they should move indirectly. Okay, does that make sense? So you can use correlation to avoid false breakouts. So just very much like the previous example I told you, when we're looking at the inverse and direct correlations, if a market is not yet moved, then that can be the signal something will happen. But if you're looking for false breakouts, you know, if a market hasn't moved at all and one is breaking out very, very aggressively, nothing fundamental's come out, then maybe that's just a false move. So if we're looking at the euro dollar versus the pound versus the dollar, this market hasn't moved at all. We've seen a strong sell-off in the euro dollar. If there's no fundamental news out or nothing potentially has happened, then what we're looking to do is just basically buy some dips. So look for a level of support down here and buy it back up because this market hasn't moved at all. Okay, we know the correlation is strong, 0.8, so nothing happens, and that could just be, you know, one particular person unwinding a big position, or it could be the market getting squeezed. So that's another way to avoid false breakouts or benefit from one market breaking out when another one isn't. You look for opportunities to turn and reverse. So if the correlation between a market is strong and you see a signal similar to the one mentioned, one of three things is generally, you know, happening. Market correlation is changing, so we check for fundamentals, check for news, and if it isn't, then again we buy back into that weakness. The volume's low, the market might be range bound, that's just a technical break, or there's a false breakout. The market is just being manipulated or traded out of range, out of value, momentarily or short term, and it will come back to value. So that's another opportunity to use these coefficients to find out of a good buying or selling opportunity. Obviously, correlations can change, as I said. And the whole point is a correlation between a day, a month, a 3 month, 6 months can change, and it can change on different events. So, you know, the euro dollar versus the, you know, the pound versus a pound against the dollar. You know, what one day could be as strong as 0.93, but over 3 months could be as weak as 0.74. So it doesn't seem a lot in the grand scheme of things, but just think again back to how much money is traded every day. You know, $4 trillion. That a big change from 0.93 to 0.74 represents, you know, billions and billions and billions of dollars. So again, them little changes can mean big things within the markets. So they're always going to change no matter what. But again, anything above 0.7, positive and negative, is something to keep an eye on. So anything above that, you know, it indicates there is that positive or negative correlation. Let's go into arbitrage. And again, this is just a thing that I don't think really kind of is that easy to do these days. There's so many spread betting platforms. Very few people have direct market access. And even on the floors, when I traded, to be honest, I couldn't be bothered with currency arbitrage. There's much more fruitful opportunities for me as a futures trader than worrying about little small arbs. And plus, I didn't have the size to make it count. But that's in the process which currency traders take advantage of discrepancies in spreads offered by other brokers, particularly in currency pairs. So a trader takes advantage of two or more banks, brokers, spread betting companies, doesn't matter. Someone that offers a price on an FX pair. So a trader will buy or sell the currency pairing, converting money with that broker, okay, at that price. So what they then do is take the opposite position with a different broker offering a competitive but out of line price with that, and then taking the difference, and that is your profit. So if euro dollar, is 1.38 on one offered at one particular company, and it's 1.34, okay, you've got 0.2 difference. You have to pay the spread anyway, but you should be able to make a small arbitrage between that. So again, it's something that's done by machines these days. It's something that's done by the robots, and it's something that's widely, and has been widely done over the years. Is there that much money for the individual spread betting FX arbitrager out there? Not really. I would stick to all the other things I've taught you, like trading news events, trading big breaks, and trading the actual currency arbitrage strength between them. I wouldn't worry about arbitraging as such. I would look for opportunities based upon the coefficients rather than the actual arbitrage between spread betting companies. So just an example, the euro dollar broker 1, broker rate is 1.3000, trader sells, and immediately, okay, at broker 2, the rate is 1.3002, so you've taken 2 points between this, and that's a currency arbitrage. Only meant for ginormous size, only really kind of small windows of opportunity, and not really what I would suggest wasting your time on. To be honest, there's much better ways to make big amounts of money than worrying about discrepancies between prices. Just think about it arbitraging between bookmakers. If someone's got odds of 3-1 on a horse winning, someone's got 5-1, then you could realistically offset on Betfair the difference between the two. But very, very long-winded, takes a lot of size, takes a lot of concentration, and for me, there are better ways to make money. So the conclusion with trading currency pairs for me is the main thing to remember is currency correlations, can hinder and help the trader. They don't always do what they're expected to do, but if you watch them and you are precise enough, there will be a strong indication of positive and negative correlations. Okay, so you have to understand the difference between the two and understand in your charts and how you set up your systems how to look for these things. So look for the correlations between the riskier pairings, so they reflect the appetite for risk. So again, look for the dollar versus the Swiss. People will trade that in times of uncertainty. So there's much more volume likely to come into the Swiss than there would be, for any other so-called safe haven. Currencies change. Again, the correlations can change hourly, daily, weekly, monthly. So keep an eye on that. And use of hedging is a good way to double up positions for greater reward and also limiting risk. But again, you're tying up more of your capital, and unless you're trading large positions, as I said, is not really the best way of trading for me. Okay, arbitrage is going between different brokers. I think that's really difficult to do these days. But again, if it's something you want to look at and you're good at automating your trading, then maybe it's something that you want to particularly focus on. But for me, it's all about looking for the positive and negative correlations and coefficients, and then finding opportunities to buy into that strength or sell into the negative weakness. Okay? Any thoughts, any questions, guys? Does that give you something to think about? Is that something you might want to look at in the future? Again, just Google currency coefficients, and you'll be able to see tables in real time that'll be able to select, the hour, the week, the day, the month, and see the differences. Any thoughts, guys? Anything you'd like to ask? Like I said, I'm back in the office now, guys. It's full on now till Christmas. I've had my 2 weeks away, so plenty of stuff going on tomorrow on FX Street. Doing a money management course, 5 different speakers, 5 different approaches, so I'll be doing that. And then obviously the Trade for Life course starts up again tomorrow at 7 p.m. So if you want to do a refresher or you want to understand about a trading plan, etc., then we're going to be doing that tomorrow night. Okay, guys, well, you know how to get hold of me, steveintra.com, at Steve Ruffley on Twitter. Anything you want to ask, anything else, guys, just let me know. I'll be here all day tomorrow and for the rest of the week. So just catch me on Facebook, Twitter. Just Google me. I'm not a difficult man to get hold of. All right, guys. Okay, would a trade this the same as the indices? Jamie's just asking. Well, I trade the currencies in the same way as the indices, as in my basic kind of support resistance, Fibonacci's. But what I would also say is that obviously the FX market's on their own. You have to look at these coefficients and look at what other things are moving. Yeah, I trade everything in the same time frames, Jamie. I mean, everything is an hourly signal. Okay, so everything for me, I always look at the hourly charts. I don't really look at anything else these days. I might look for an entry point in a 15-minute chart, but yeah, definitely I'd look on the currencies, hourly charts, for your fibs, and hourly chart. Yeah, definitely. I'd look on the currencies, hourly charts for your fibs and hourly charts for your Bollinger Bands, definitely. That doesn't change for any product, to be honest. No worries, Jamie. Good to see you, mate. Good to see you. Okay, well, any other questions, guys, you know how to get a hold of me, and it's been a pleasure. All right, guys, have a great night.